Hello and welcome back, everyone, to Dirty Boots Capital. Today we have a very special guest with us, Mauricio Rauld. Mauricio is an attorney and the founder of Premier Law Group, which specializes in syndications. So I wanted to get him on the show so we could talk a little bit about syndication. So welcome, Mauricio.
Well, thanks for having me, Tony. Don't tell people I'm an attorney. That's going to scare people off. People are going to tune off. They're not going to. I'm known as the anti-lawyer, Tony. I'm the anti-lawyer. Everything you can think of as an attorney, I'm the opposite. But yes, I am a licensed attorney.
No, one of the quotes that I read about you, Mauricio, it was a great quote, and I love it because it's absolutely true. For the folks out there looking for a syndication attorney or looking for syndication advice, if you're an investor or something, you need some help. Mauricio is absolute. So the quote reads like this. So one of the few lawyers who speak English, right? And I think all of us can kind of relate to that, right? Because you go to an attorney or a lawyer and they, sounds like gibberish half the time, like they're talking a totally different language. So
yeah, my good buddy Tom Wheelwright, one of the Rich Dad advisors, coined that term. He says I'm one of the few attorneys that actually speaks English, and I think he gives credit to Garrett Sutton, who's a good friend of mine too. Garrett's another attorney that's very good at communicating. He's an asset protection specialist, and he's very good at articulating and educating and teaching. So yeah, very honored to have that title, and I think it's true. I have that little knack of taking these really complex securities matters and esoteric and nebulous and all that stuff, and just I try and package it in an easy way to understand.
Yeah, and so a little bit more about your background, so the viewers understand the scope of, the crowd you run with and the world you operate in, right? So not only are you an attorney, created your own law group there, but also you wrote the book, five things every syndicator must know to stay out of jail, right? So that's a fun title.
Yeah, it's a fun title, and it's a very purposeful title, because what I realized was a lot of people were out there doing syndications and either not knowing about it or not really taking the securities law seriously, because everything's been going so great the last 13 years, and so I wanted to make it a point, and that's why I used the word jail. Now the reality is, unless you're defrauding investors and you're probably not going to go to jail, but the consequences are severe. I mean, the consequences of having an unregistered offering or an illegal offering or a non-compliant offering, however we're going to talk about it, is serious. It includes rescission, meaning you've got to give investors their money back. It includes being barred from raising money again. It's probably bankruptcy. I mean, there are some serious repercussions, but I wanted to catch people's attention with that jail, which is possible. I mean, you can go to jail. Just ask Bernie Madoff. But yeah, that's the reason for the title.
Yeah, no, it's definitely catchy, and yeah, it's a fun title for sure. So you've also been on the Real Estate Guys radio show many times, right? So you bring a lot of credibility to the table. So I appreciate you joining me here today on Dirty Boots Capital, right? You are also the personal advisor for Robert Helms. He's one half of the Real Estate Guys. You're the attorney for Ken McElroy, right?
I'm the legal advisor for his YouTube channel. Yeah, we just started that about 3 or 4 months ago. But yeah, if you go on his channel, I create a lot of content. We're actually having our first happy hour, probably before this already airs, but we're having our first live happy hour next week at Kenny's office. It'll be fun.
Yeah, absolutely. No, Ken's a fun guy. I love having conversations with him. So, and then you're also hanging out with the likes of Robert Kiyosaki, Peter Schiff. You're not just some guy off the street that we have here, right? You are a rock star when it comes to syndications and protecting these guys, right? These big names, right? These guys are the ones going to you saying, hey, Mauricio, how do I stay out of jail? How do I protect my investors, right? How do I do all these things? Right.
Yeah, I appreciate that. Yeah, but I've been doing this for a while. I've been doing this for over 20 years. Now, just to be clear, I don't represent Robert. I know I've gotten to know Robert Kiyosaki well over the years, but I don't represent him. But we hang out quite often. I mean, you and I were hanging out with him not too long ago, and he usually comes to our, when I say our, the real estate. I used to be their general counsel, which is like I keep catching myself saying our event and our things, but it's the Real Estate Guys' event. We have a great event once a year. I said it again. It's a summit at sea, and we have just an amazing faculty, and that's where I'm part of that faculty. And Robert Kiyosaki, I think, has gone 8 or 9 times, and Peter Schiff attends, and Ken McElroy obviously goes. It's a really high level, high caliber event with an amazing faculty, and that's where I've got to have the pleasure of getting to know these guys a little bit more on a personal level and spending a week with these guys.
Excellent. Well, thank you for joining us and sharing a little bit of your backstory there, because I think it adds a ton of credibility to our conversation that we're going to get into now. Yeah. Here is so the first thing I want to ask you is, not only from a syndicator's perspective, but also from an investor's perspective, why would anybody want to get into syndications?
Yeah, why wouldn't anybody not want to get into syndications? What typically happens is the journey of a typical real estate investor is somebody gets the real estate bug, whether it's early or late, and they start acquiring properties. And it's not uncommon for people to start buying single family homes or a condo. I mean, my first property was a condo. Ken McElroy always talks about his first property was a 2-bedroom, 2-bath condo. So everybody starts small. They're putting their own money down. It's their credit. They do all the work and everything. And then sooner or later, they typically just run out of money, or they run out of credit. You know, usually with a personal loan, you're going to be limited to 10 loans. And so at some point in that journey, you realize that you've run out of money. You want to continue to acquire more and more properties, but you've just run out of your own capital. And so the next natural step is to start accepting or going to your friends and family and saying, hey, look, I really want to buy this property. It's really great. I'm kind of tapped out of cash, or I just have a little bit of it. Why don't we go out and pool our resources? Why don't you give me 10 grand? You give me 20 grand. Let's get a pool of money together. I'll run the show because I'm the expert. I know what I'm looking for. I know the stuff. You can just write me a check. Look how I've done, look at the returns, or here's my credentials. I've been doing this for X amount of years. These are all the properties we've done. My formula works. I just need capital. And then you go out there and get additional capital. And that allows you to continue to just keep acquiring real estate. And, there's really no limit to the amount of real estate you can acquire. And there's no limit to the amount of money you can make from this business, because if you are good at what you do and can add value, which is the most important thing, right? If you can add value to those passive investors who are busy with their jobs, they don't have the time to go to conferences, they don't have the time to educate themselves, they don't have the expertise, they don't have really the inclination either. They're doing their own thing. If they can turn to you as an expert in the field, give you their hard-earned capital, and you can go there and multiply that capital and give it back with friends, then it's a win-win for everyone. The investor gets the benefit of return. The investor gets usually the benefit of the tax breaks that ordinarily they wouldn't get, because, in order to get some of these amazing tax benefits, let's just deviate a little bit, but hopefully I'm not going to talk out of school because I'm not a CPA, but in order to get a lot of these tax benefits, you really need to be doing larger and larger deals. For example, this bonus depreciation, which is one of the main tax benefits going on right now. In order to do that, you've got to actually do what's called a cost segregation study, which costs money and it takes time. And so it doesn't make sense to do that on a single family or a duplex. But if you're doing an apartment building with 10, 50, 100, 200 units, it makes a ton of sense. You don't have the money to go buy a 200 unit $30 million apartment building, but you can buy as a passive investor, you can buy a small slice of that for 10, 15, 20, 50, $100,000 and get that tax benefit, because it's all going to trickle down. So there's just a ton of value for the passive investor. And of course, for the syndicator, it's just a way for them to continue to accumulate real estate without having to use their own money, because either they ran out of their own money or they don't want to use their own money because they don't need to. They can actually tap into these investors.
Yeah, so this idea of being able to pool money together through various investors, right, to achieve this economies of scale, right, that you normally wouldn't be able to do. And the way I like to look at it is, typically with economies of scale comes lower risk, right? And so you think about it, I think about it, and I share with it when I educate. I share with it, hey, if you're an investor and you have one condo that you're investing in and you're renting it, and you have to evict the tenant, or you have a turnover and that condo is vacant for a month, 2 months, 3 months, you're out of cash flow for that entire time. Whereas if you are part of a syndication as an investor and you've bought into a syndication that has 200 units, right? Now, if one of those 200 units is vacant, or tenant is being evicted, or is being turned over, the impact is much, much, much less. So the risk through a syndication, I think, is offset, right?
100%. The vacancy is one big thing, as you just mentioned. Even if you have a fourplex, if suddenly one of those tenants moves out, you're down 25% vacancy. That's a huge number. But with a 200 unit apartment building, like you said, it's negligible. You also get economies of scales on the expense side, so on the maintenance side. And once you get to a certain level, it's usually about 50 units or 75 units. Well, now you can have an in-house, on-site management guy who's an employee and full time, and so the cost per unit starts to go down once you do larger and larger deals. So all those economies of scales, all those benefits that run with the project will trickle down proportionally to your ownership. So if you own 2% of that syndication, then you're going to get that 2%. So from your own investment, you're going to get, it's as if you had bought the whole thing yourself, but just at a smaller scale, because you've only put in 50 grand or something.
Absolutely. And then one other thing I want to leverage off of is, so still sticking with the why do a syndication, both from the syndicator perspective and the investor perspective, is for me, I look at it, a big reason is you can get into different asset classes, right? You can do a syndication and buy multifamilies, you can buy medical facilities, you can buy office buildings, you can buy mobile home parks, right? I mean, that's all possible, right?
You can do all that stuff. So it's just a question of what's really at the end of the day is what are your interests? What as a passive investor, what are you trying to accomplish? Because maybe you don't like multifamily, but you like mobile home parks. So great, there's going to be somebody that's raising capital for a mobile home park, or maybe you like, medical office buildings, or maybe you like commercial, maybe you like having the Dollar Tree store, the 99-cent store, and own some of those commercial, malls or whatever. So there's something for everyone, and it's just a question of making sure that your interests are aligned with whatever the syndicator is proposing.
Yeah, absolutely. So let's launch into that question, right? So what defines a good syndicator versus somebody who's just selling snake oil?
Well, that one should be easy, right? Hopefully, the difference.
Hopefully, but
salesman but look, a good syndicator, in my opinion, number one, has obviously experience, right? They have a track record. So the more track record they have, the more experience they have. It means they're more likely to be able to execute on the business plan. Because the number one thing I believe that a passive investor should be looking at when considering a particular investment, like a syndication, is looking at the sponsor. Like, do they have the track record? Can they pull off? They put together this nice glossy pitch deck, and they're promising all these great things they're going to do, and that's nice. But do they have the ability? Do they have that expertise? Do they have the track record? Do they have the team that they can actually go execute on that deal? Right? Are they a one-off person who's never bought a piece of real estate in their life, or are you somebody like a Ken McElroy who's got 10,000 units and been doing it for 20 years and has just been killing it? Right? Those levels of experience make a huge difference. And then the other thing I think would really separates let's say separates an average syndicator from a good syndicator is making sure that the syndicator is focused on the passive investor. What's in it for the passive investor? How can I add value for the passive investor so that I'm not pushing something on them that they don't want or don't need? It's like, what are your needs? Oh, you have a tax problem. Okay, well, let's figure out a project that can maximize tax benefits for you because you're a high-paying professional and you want to get your taxes down. Let's focus on that. Oh no, you're actually retired, a retiree, and you're not really too concerned about tripling your money. You just want to make sure you get a constant stream of cash flow, and you'd be happy with 8, 9, 10%. Well, that's different from somebody who's 25 years old and wants to get a 3x return on them. So just understanding what kind of investor your investor is, just like when you fill out a stock, you open a brokerage account and they ask you, like, are you looking for growth or cash flow, or are you conservative? I mean, you really want to figure out first what your investor wants, and then go find something or present to that person something that fits those needs.
Absolutely. No, that's a good explanation. Now, what about, so I've run into some syndications that are run by two general partners, right? So instead of just one syndicator who's pulling the investors together, there's two general partners running the syndication. Does that add any risk to the investors, or does that reduce risk because now there's two people in front of the syndication? What do you think?
Yeah, I mean, I think it's not uncommon to have at least two people. It's a lot of work to put, especially if you're buying a 100-unit apartment building. So it's not uncommon for one or two people to get together, if they're not already on the same company, the same team, to partner up. In fact, these days, it's not too uncommon to see 4, 5, 6, 7 people partner up in order to do it. So I think having more people helps, because obviously you've got a team, and maybe somebody's boots on the ground. Maybe the syndicator lives in Arizona, and their property happens to be in Florida, and so they've partnered with somebody who's actually near the property in Florida. So there's somebody that's boots on the ground who can actually have more of a pulse on the market and the relationships and the brokers and the agents and the property manager and all that stuff. But I don't think it adds any more risk. Other than, and it really actually is not even more risk for the investor, but other than when you get too many GPs or too many sponsors, the question often arises for me is, what are all these guys doing, right? So yes, it's probably better to have two than one, because again, you can split the work and the risk between the two of you. But at some point, you got to start asking yourself, are these people really, why are there 10 people on this team, 10 different people? And a lot of time it's because they're coming in and raising capital, which potentially could be something that's not allowed from the SEC perspective, but that doesn't really affect the individual syndicator. If anything, it might help them, because as I mentioned at the beginning, if things go south, that's something you might be able to get a refund of your money if they haven't been complying with the securities law. So my job is to make sure those GPs are doing it right. And that's one of the issues I sometimes come across is people trying to raise capital. That's it. They just want to get paid to raise capital, which is not allowed without a license. Yeah,
no. And we GPs, we appreciate you, Mauricio, keeping us out of jail. And so, I look to raise capital, not only for my own syndication, but also, I look to partner with others, right? So from my perspective, we talk about reducing risk through a syndication for the investor, right? So I know folks who are general partners who are excellent at raising capital to buy a larger complex to reduce risk, right? But they don't hold a footprint in the areas I'm looking at, right? Where I'm an expert, where I love the term you use, boots on the ground, right?
Right.
Right. That's where I come in, right? Because they may be in a totally different state, West Coast, central to the country here, but they don't operate where I operate. So it's great to be able to leverage each other, others for capital and me for boots on the ground. Other people come in as a general partner who are just superstars with being able to look at the underwriting, right? Underwriting a property is huge. You have to know how to do that. You need to know how the property is going to cash flow, where to take risk out, where the opportunities are. So looking at the underwriting process is huge. That's a totally separate piece of it, right? So yeah, and I don't want investors to get scared if there's just one or if there's three or even four. It goes back to your point of it all depends on how the investor is aligned with that particular syndication and what that investor is looking for.
Yeah,
right?
100%. And sometimes they have they have relationships, for example. I mean, you may suddenly, with your underwriting, you're looking at different markets, maybe you want to expand and you suddenly realize that, let's just come up with let's say you realize that Huntsville, Alabama, that's kind of popping up here every so often. So Huntsville, Alabama is a market that you suddenly want to be involved because you're seeing some macro trends and you really think that's a place that's going to be, you're going to ride that wave. Well, you don't know anybody in Huntsville, Alabama. You don't know any other broker. You don't have a team. You don't have property managers. You don't know who the real estate agents and brokers are. You have no relationships there. And this is a relationship business. So people who actually sometimes get the deals are because they have a relationship, and sometimes they're off market. They never make it to the public. So having somebody who's already there and established in Huntsville, Alabama, who has the relationships with the brokers, has a relationship with the property managers, has all these relationships, they come onto your team. And like you said, you can now leverage that. And now you're not going into Huntsville, Alabama completely blind. You're going in there with somebody who's local, essentially local, and knows their stuff. And you and the investors can then now benefit from that leverage.
Excellent. Yeah, you're absolutely right. So for investors out there, if they're looking to vet their syndicator to make sure they're a syndicator, one of the things I always share with folks looking to get into syndications is, give the attorney who is the in front of the syndication, give the attorney a call, right? Give the CPA firm who's in front of that syndication, give them a call, ask questions about that particular syndicator. Give whoever they're going to use for property manager for that particular property they're looking to buy, right? The investor should call that property management company, right? I don't think investors should feel bad about vetting their syndicator by calling the attorney, calling the CPA, calling the property manager, and possibly others, right?
Yeah, I think that's the number one thing. I mean, at some point I put together a checklist, and I mentioned it earlier, but the number one thing is the due diligence on the sponsor. And all the things you just mentioned is part of that due diligence. And so the idea would be, and again, passive investors are busy professionals. They don't know stuff. And so they're busy doing their thing. And this is meant to be leveraged, but the work just has to be done up front on maybe once, right? Once you vet a particular sponsor and you're comfortable with them, then obviously the next deal, you don't have to go do it over and over again. So that's one of the benefits. But absolutely, obviously when you're trying to figure out, who is, like you said, the property manager, you're doing a due diligence on the property, who are the property managers? How long have they been working with the sponsors? Is this the first deal they've ever done with this property manager? That's part of this whole thing. You want to get referrals. If you can pull that off, like try and talk to other investors who have invested with this particular thing, with this particular sponsor. Talk to the sponsor, talk to their team. How big is their team? Is it just them and it's a one man and one woman show, or do they have an experienced team behind them? And how big is that team? And another important piece, which is another reason you would leverage, for example, we talked about earlier, is do they have the expertise in that particular asset class? Because they may be, experts in multifamily, and they've got a great track record of purchasing 50, 100, 200 unit apartment buildings, but this project's actually a mobile home park. Yeah. Right. So do they have any experience in mobile home park? And so sometimes the answer is no. And so you bring in a partner who's an expert in that. And so again, you're leveraging, well, I've got the skill of relationships and investors and structuring deals and underwriting, but let me bring somebody who's an expert in that thing. So all of that due diligence, I believe, is the critical spot, because again, anybody can put together a pretty glossy pitch deck and, everything's going to go up great. The key is, can they execute on that business plan? And that's all going to come down to your due diligence on the sponsor and due diligence on the actual property once you're comfortable with the thing. And so calling property managers, calling attorneys, calling anybody who's part of that world in my mind, would be fair game if you can do it.
Excellent. Excellent. Okay. So one of the questions I get asked by investors is, as an investor, can I get sued?
The answer should be no. If you're a passive investor, right, and therefore you have basically no voting rights, right, you have no say in the property, and so that's where you kind of get, some people get too much. They want actually control. I'm like, no, you don't want control, because the minute you have control. But no, you're investing as a limited member, as a limited partner in the syndication, which means your exposure, your liability is limited to the amount of money you put in, right? So if you invest $50,000, the most you could lose in that investment is that $50,000, unless you've done some other guarantees or something. But that's the idea, because you are a limited partner. Now, in exchange for that protection, you're not going to have any, you're going to have some voting rights. Or, I mean, obviously, if the manager is stealing or doing something fraudulent, then you're gonna have the ability to vote and see if you want to replace the manager. But you're not going to be involved in the day-to-day. You're not going to be going to meetings. You're not going to be influencing the decisions. And that's actually what gives you that protection, because you're literally just a shareholder. It's no different than if Apple, if Apple got sued, you wouldn't get sued if you own Apple stock, right? You're just a stockholder. You're like in that one, actually, theoretically, you have some voting rights, and here you do, but it's such a minuscule that you really have no control over Apple. So nobody can come to you and say, hey, you as a shareholder should be responsible because you somehow contributed to whatever the wrongdoing was. When you're a limited partner or a limited member, you have zero control essentially. And so you're not going to be responsible for any, mismanagement or, negligent acts or intentional or fraudulent acts from the sponsors, as long as you're not involved and you're a true limited member.
Yeah, I love your comparison to owning Apple stock. And that is a great, it just kind of creates the picture in somebody's mind how, getting sued by owning Apple stock just won't happen. And so I use the example, because I used to self-manage, my properties. And I use the example of, if I was to go there as the owner of the property and say, fix a hand railing on some stairs, and somebody ended up falling down those stairs because the hand railing wasn't secured, I didn't do a good job, something like that. Regardless of whether I have the property in an LLC or not, I am still liable for any injuries, right? Any lost work time, right? Because I personally went there and I fixed the railing for that set of stairs. Whereas through syndication, an investor isn't going to be walking on the property and making repairs or, interacting on a day-to-day basis. So they're so far removed from any legal action. Comparing it to owning Apple stock is a great way to picture it in an investor's mind. So, and then, so last question I have for you, and it's important for both syndicators and investors. Help us understand, talk a little bit about private placement memorandums, right? Why is that important?
Private placement memorandums are my favorite analogy on a private placement memorandum is if anybody's gone to the doctor and had surgery, whether it's major surgery, minor surgery, or the story I like to tell is that I have horrible teeth, right? I have terrible maintenance of my teeth. And so I've had numerous oral surgeries, right? Sometimes it's just taking out wisdom teeth or whatever, but they literally go in there, they put you under for like 3 minutes and then they do whatever they're going to do. And then you wake up or whatever. And so prior to any surgery, the doctor comes in and gives you this, it used to be a yellow sheet called a medical consent form. And in that form, they would outline all the risks that are involved in that particular procedure. And in my case, for oral surgery, hey, you could have some swelling, you could have some bleeding, you could get an infection, you could die. I mean, all these things that could happen in this 3 minutes I was going to be under, that was all in that medical consent form. I would review it, would sign off, the doctor would sign off, and boom, we're ready to go. It's the exact same thing with the private placement memorandum. The PPM is a document that discloses all of the risks involved or even potentially involved in your deal, so that an investor can review all those risks and they can make an intelligent decision whether this is something that they want to proceed with. They've got all the material facts, all the important and relevant information, and now they can make an intelligent decision whether this is something that they want to invest in or not. A lot of times the PPM is a required by law document. So anytime, for example, probably the most common scenario is anytime syndicators are selling these securities or having passive investors that are non-accredited, meaning they're not high net worth individuals, they have less than $1 million in net worth, or they make less than $200,000 a year, then that is going to be a required document that they must provide the investor with all of the ways they could lose their money. It's not a pretty document. It's basically, you've got to think of all the ways they could lose their money. Yep. And now, for example, an interesting one, I mean, we usually have more broader language, but now we've got COVID language in there, right? Because now we've got COVID coming up. And so we have all those potential risks that something can happen so that the investor can go in and sign it. And so a lot of times it's required. required by law. And that's actually one of the red flags that sometimes pops up from a syndicator, that if you're a passive investor and you're not getting a PPM and you're not an accredited investor, that's going to be a red flag. And you should ask the sponsor why not, and find out, most of the time it's some nonsense story that they give you as to they just want to save the money and cut corners. But the issue that I found is whenever they start cutting corners on the legal side, on the documentation side, they're usually cutting corners somewhere else, and that's proven to be true. I've got several little nightmare stories about that. But that's ultimately what a PPM, it protects. It actually protects the document itself is meant to protect investors. It's going to have a consumer protection law, meaning we want to make sure the investors go into this investment obviously with all the relevant information. So that's protects the investors, but it also protects the syndicator, because I call it a double-edged sword, because it becomes very difficult for somebody if things don't go well and somebody wants to complain. You can just go to the PPM and say, look, hey, here it is on page 78, subsection 4. We disclose that this what ended up happening was something that could potentially go wrong. And so I told you about that risk. You were aware of it. You decided to go forward with it. I'm not going to be responsible for any damages that come across from that risk that obviously that I didn't create. Obviously, if I created the risk, if I was mismanaging, or I made some decisions. But for a great example would be, for example, back in 2008, right, when all the credit markets froze and we had a huge great financial crisis that nobody. I know some people like Peter Schiff will say, which is true. Some people did see it, but generally speaking, nobody really knew. And so it's very difficult to come back and say, hey, you never told me that we could enter into a recession, because that's all disclosed in the PPM, right? So that's what a PPM is in its essence. And I would say 99% of the time you should be seeing a PPM in the documentation that you're reviewing if you're a passive investor, and that's one of the documents you should be providing your investors if you're a syndicator.
So syndicators out there, make sure you have your PPM, your private placement memorandum, in order, right? And for investors, make sure you are reviewing it, cover to cover, make sure it's right. And so, Mauricio, you are a wealth of information. I love chatting with you about this sort of stuff. I don't want to take any more of your time, but for syndicators who have questions, or investors who have questions, who need some of your time to maybe review a PPM or get some legal advice, where can people go to find you?
I think the easiest, if you email jail@premierlawgroup.net, jail@premierlawgroup.net, that'll actually get you that ebook that I have, the 5 things every syndicator must know to stay out of jail. And then I'll get an email from there. So you can actually put a little note in there, and that'll get to me. I also do a weekly Q&A show now, where you can come on and just ask me basically about anything. And that's a Zoom call on Wednesday evenings at 4:30 Pacific. And if you want to go on that, you can just go to mauriciorauld.com/live, and happy to see you and join us. We had about 75, 80 people last week. So excited about that show.
Excellent. We'll put those links down below so people know where to find you. And again, thank you for joining us here on Dirty Boots Capital. This was a lot of fun.